Oil is never, ever going over $100 a barrel again.
Do you realize that you're lying, and I'm going to prove to you why.
All right, let's talk about it. So, the $100 lie, everybody on Wall Street, everybody's talking about how oil will never get over $100 a barrel. We're going to demystify that because there's three basic premises that they're building it on. You know, all the institutional money, Wall Street, and a lot of the trading shops and everything that you read, oil will never get over $100 again. And the analysts claim it's a ceiling, and the consensus is confident that it's completely wrong. So we're going to talk about it. We're going to talk about the three core principles. So what's the first one, Bill?
So everybody thinks that the Permian is like the magic wand illusion. It's the, oh, we just turn on the taps and it happens. And they like to use the term turn on the taps because they think of water. I turn on my tap and the water flows out. See how easy can it be? Somewhere there's a lake. I'm just telling you. There's a lake, there's a water tower, there's somewhere where all this comes from. And the infrastructure it takes to get it from that source to your tap requires a lot of things. It's mostly done by a government that charges you more for it than anything. But if you don't keep that infrastructure up, it doesn't happen. So that means you have to have economics. No one's going to invest in infrastructure unless they have a return on investment. No one's going to invest in infrastructure in the oil and gas business unless there's a return on investment. So first, shareholders always demand capital discipline over growth. You know, it's the old watermelon story. If you buy watermelons for $1 and you sell them for $1, and the two guys come back, they get at the end of the day and they don't have any money. So the guy says, well, we're going to need a bigger truck. No, you don't need a bigger truck. You need to make money. You have to have that capital discipline for when you invest. Number two, tier one acreage is depleted. I don't know if it's completely depleted, but it's not coming out as fast as it used to. And so some of the best spots are already drilled. There's a whole nother thing here about natural gas. We won't get into that today, but there's a whole nother thing about that as well. Service cost inflation eats the margins. It's not service cost inflation, it's inflation that affects the service costs.
Mm-hmm.
And so what's happening is those costs are getting higher. The margin gets eaten alive. Once again, we go back to number one, demand capital discipline. We can't, no one's going to produce at a loss. I don't care how nice they are, they're not going to produce at a loss. So when you start talking about that, if you really want true growth, growth being more production coming out, and we can talk about decline too, which means that we're going to need more production. So true growth means we got to get beyond decline, above decline. That's going to take a price, and I'm not talking about just the price at the NYMEX Cushing. I'm talking about a price back in the field that's going to be closer to $100 and probably above $100 on the NYMEX exchange as opposed to being in the field. You guys should understand what that means. When you go back to it, we can explain it to you. We do this as Energy every day. We look at the markets every day. And so down below, you got a chance to click and subscribe, sign up for a ebook, and understand the energy market better. But it doesn't just, there is no tap to turn on. So
We spent
Brian,
a year over $75 and didn't
oh
grow.
yes,
I mean,
exactly, didn't grow.
we grew a little. We grew a little, right?
But Brian, I think that EVs are going to change the world, and it's going to mean we need no more oil in again ever. What do you
Okay,
think?
so this is the other narrative around oil markets is that the oil is at the final inch of the energy transition. In other words, we're going to get off oil. We're just going to stop. We're just going to stop using oil. So the first factor is that EVs only impact gasoline, which is 20% of oil demand. The other 80%, the other 80% of the market is in plastics, fertilizers. It's in just about
Diesel,
everything you're wearing,
bunker fuel.
your computers, microchips, everything. So yes, gasoline and switching over to EVs is going to change demand significantly. But there's another aspect here. Asia. Asia's appetite has been growing, And so, as much as EVs has been reducing the gasoline demand, the growth of oil consumption and oil related products, whether it be microchips, whether it be the computer screens, whether it be clothes, whether it be whatever, is dwarfing that transition. So, new demand as Asia has gotten more industrialized and more rural has become more urban, and there's more growth in Africa and India coming. And this is the velocity trap. So supply destruction is happening faster than demand destruction. So what does that mean? That means at the basic economics that we have right now, we're not going to be growing oil supply. I just looked at it yesterday. Over the last year, we've grown in the United States only a couple 100,000 barrels a day. Prices were $10 higher over the last 12 months. So that means at $10 lower, we're going to start producing less. So the energy transition, as much as advanced economies and mature economies in Europe and North America are shifting away from oil and into EVs, there's so much more new demand in India, Africa, Asia that is just dwarfing that demand. But the other aspect of this is really we talked about supply not being able to grow in the Permian, not being investable around the world. Well, I've heard all this offshore amazing oil discoveries that we've had over the last couple of years, Bill.
Well, let me tell you something. If you think that developing oil on land is expensive, double it and throw it out in some water. That's exactly what's going to happen. So we hear about these new discoveries, Guyana and Brazil, Namibia, all are making headlines. Are long-term investments. We're talking a decade or longer before we see significant increase in production out of those spots. And what's going to happen, Brian? What always happens? The easiest oil is the first to market.
Mm-hmm.
From there on, it gets more expensive and harder to get. And
Mm-hmm.
so 10-year developments, multi-billion dollar investments, the math is not hard to do. Everybody has a calculator. When you start looking at your costs exceeding $100 just to get the capital to come to it. So the industry runs on borrowed money. That's why capital costs are very important. And
Mm-hmm.
so and we haven't talked about what it does when you start getting interest rates and inflation. That is probably the single one killer of everything else. In that once you start paying, even over 5% to borrow this money, the price has got to go up. Or let me put it more bluntly, the price will go up
Right.
because the demand does not go away. So the price will go up when supply is on the squeeze.
Well, and I think if you go back 20 years, oil was $60. And what's happened to costs? Costs have come up 200, 300% in that time frame. But yet we got the same oil price. Yes, there's some more efficiency, but that, that last factor, that's a biggie, Bill, right?
Right. And fact is, when you start looking at inflation adjusted numbers for what the price of oil is today, it's amazing how good a value it is as far as how cheap it is. It's just not going to stay that way. It can't. It can't do that and survive.
Right. You're exactly right. So, wrapping up, we've gotten the real price floor. $100 is just the beginning. There's a massive underinvestment cycle that is happening, that years of capital starvation. And that capital starvation was happening $20 higher. We needed higher than $80 to start investing more and more and more. Now you get into the second factor, supply demand squeeze. All three solutions require higher prices to work. So that means supply has to come up to match that growing demand in Asia, Africa, and India. So, as much as EVs are eating into gasoline demand, yes, that is going to impact things. But there's so much other growth in other regions of the world because oil is a global commodity. So when you look at there is increasing demand. I mean, guess what? We're consuming over 105 million barrels a day, and that is up from 100 million barrels a day just a few years ago. So we are continuing to grow our oil consumption. And there's a lot of expectations that the energy transition with the Permian, the energy transition is killing demand. The Permian and these offshore developments are just going to have so much supply that you're not going to need high prices. Well, the
Well,
fact is, oh,
Brian,
go
the
ahead.
problem is we're running out of rabbits.
Rabbits? What do you mean?
Yes, we can't. The industry cannot pull any more rabbits out of their hat. We start off with, we're at the end of the ducks,
Yeah,
ducks and rabbits. You'll
ducks and
listen
rabbits.
to us. So we have no other things to pull out. And what the numbers are telling us this, and that's what me and you pay attention to. It's what the
Right.
numbers are. That's what Energy Rogue is all about. Is showing you the numbers. We're not saying you have to believe us, but we'll give you the numbers, and you can believe yourself
Yeah.
as you do the research. So we really think that we see the bullish future for crude oil. It has really nothing to do with EVs. Don't get caught up in headline fundamentals.
Right. And that's part of the reason that we created energyrogue.com. If you go there, you can find out a little bit about us and our products. We have Rogue Radar and Rogue Edge, and they are designed to help you understand energy markets, specifically oil, specifically natural gas liquids, refined products, and electricity. And we take a look at this every single day. We have products and tools that give you an idea of what the fundamentals of the market are, what the technicals are, and what the sentiment of the market is. So all three of those influence the prices of the marketplace. So what we see in the future and prediction is very hard. And there are predictions that we make and predictions that others make. And let's just say predicting the future is hard. Otherwise, everybody on the planet would be a quadrillionaire. Is that a thing? I think we're
I,
going to
I,
have one of those.
yeah,
That's
surely somebody's going to. It's probably going to be a tech guy though. Once all said and done,
right.
and you know what? If you think even predicting the past is starting to get hard nowadays.
Yeah. And summing up, $100 oil isn't impossible, it's inevitable. And the risk is staying trapped in surface level consensus analysis while the fundamentals shift beneath you. This is a massive shift that has been in the works for the last 8 years. And we've been watching it inch by inch everywhere along the way. And if you don't take a look at what's happening underneath the surface, you're going to miss something. And that's what we're looking at is we're looking at the structure and saying that there is a likelihood. Now, that doesn't mean it's going to happen tomorrow or next week or next month or in the first 6 months of 2026, but it could.
It
That
could,
demand is the key. If demand numbers pick up, right now demand numbers are terrible. And that's the reason crude oil prices are inching down and probably will be for a little bit.
but we've seen
Uh,
decline. We've seen decline catch up with supply. That's going to put the squeeze on. So it comes from both sides.
well, let's just look at it right here. Okay, so this is crude. This is our crude radar. Let's take a look at the fundamental analysis in the United States. Crude oil production right now is 13.7 million barrels a day. Our 3-year average is 12.9, so that's up 700,000 barrels a day. Just last year, we were only 200,000 barrels a day less than we are right now. So over the course of a year, it took us that long to get 200,000 barrels a day. And now I'm going to show you something inside of Rogue Edge, and this is my favorite chart. This shows how much production we're adding every single month. And right here is December. We're adding 11,000 barrels a day out of 13.8 million barrels a day. And guess what? We decline. We decline 650,000 barrels a day every single month. That means we have to bring on 660,000 barrels a day to get that 10,000 barrels a day. So declines are real. This is real. And $100 appears inevitable to us. When is going to be a big question. If you want to stay tuned and stay on top of it, we stay on top of it every single day, every single week, and our members know everything on every inch of the way. If you want to stay on top of that, sign up with us. If you want to learn how to understand the oil and gas markets in 5 minutes a day, sign up for the ebook. So I think we did it. Did we
That's
do it?
it, folks. Listen, you get that subscribe down there and you get that 14-day free trial. Then we would love to have you as part of the Rogue Nation. So sign up and let's talk about the energy markets together.
Yep. So thanks so much, folks, and we will see you next week.